Hello and welcome to Fund Screener. Our aim is to provide the most comprehensive fund and ETF research on YouTube, specifically for UK investors. In today's video, we will be looking at the Fundsmith Emerging Equity Trust, a unique emerging markets investment trust here in the UK. Historically, the fund has failed to deliver, but now may be the time to buy, so let's have a look. As a reminder, all the research that went into putting this video together and more is available in the show notes, which you can download from the link in the description. If you enjoy this video and like what we're doing, please remember to hit the like button and subscribe for more videos just like this. Our hope is to provide content that is valuable and empowers you to make better investment decisions. So let us know in the comments below how we can best serve you as our viewers. The Fundsmith Emerging Equity Trust, which trades on the London Stock Exchange with the ticker symbol FEAT, was launched in 2014 by Terry Smith, possibly the UK's most famous fund manager. Smith's approach was simple: to implement the winning strategy from his flagship Fundsmith Equity Fund and apply it to emerging markets. Fundsmith Equity has enjoyed storming performance, with accumulating units gaining 134% in the past 5 years. And, with attractive demographics and increased spending power among a growing middle class, Smith was confident Fundsmith's signature strategy was primed for success. Terry Smith, however, stepped down from running FEAT in 2019, and management has since been taken over by Michael O'Brien and Sandeep Patodia. Both Michael O'Brien and Sandeep Patodia were previously analysts working under Terry Smith on this fund, so the change should ensure continuity whilst also bringing some fresh air to the leadership style. The Fundsmith strategy turns on 3 axioms: 1. Buy good companies, 2. Don't overpay, and 3. Do nothing. But has FEAT successfully implemented this strategy? Michael O'Brien has 4 metrics to screen for good companies, and these are quality, growth, predictability, and sustainability of profits. The fund looks for quality companies. These are identified as companies with high returns on capital employed. A comparison between FEAT's top 10 holdings and the top 10 constituents of the MSCI Emerging Markets Index shows this difference clearly. The average return on capital employed for FEAT's top 10 positions is 37.1%, compared to 9.8% for the index. And just shy of 80% of companies in FEAT's portfolio have net cash on their balance sheet. Companies which are able to reinvest cash flows at high rates of return into their existing business lines are sought, and Michael O'Brien has stated that he likes businesses with high frequency, small ticket transactions, with a good moat to ensure sustainability of profits, and it doesn't really matter where that moat comes from, whether it's gained through brand reputation or product quality, or alternatively through barriers to entry created by regulation or high capital intensity. Fundsmith make it very clear that their ideal holding period is forever, and that they will only exit a position for 4 clear reasons: a bad capital allocation decision by management, whether that's concerning an investment in an existing business line or an acquisition, a fundamental reappraisal of the investment case, if the valuation becomes indefensible, or if a superior investment opportunity exists elsewhere. It's important to note that an indefensible valuation is not the same as a valuation being high. Fundsmith believe that good companies are rewarded by good valuations, and if you sell out of your position, there's no guarantee that you'll be able to buy it back in future at a cheaper price. However, it is unfortunately on this final point, the do nothing, that FEAT under Smith and under the joint tenureship of O'Brien and Patodia has failed to deliver on their strategy. A comparison between FEAT's portfolio turnover since inception in 2014 and Fundsmith's flagship equity fund over the same period highlights this. Unfortunately, like many best laid plans, the performance has just not delivered. Over the past 5 years, FEAT in purple has underperformed the MSCI Emerging Markets Index as tracked by EIMI, the largest EM ETF on the London Stock Exchange, in pink by 54.76%, returning only 58.15% in the same period that EIMI returned 112.91%. However, before you write this trust off, it's important to dig into why this may be. FEAT employs a distinctive bottom-up approach that's in line with the strategy as discussed earlier in the video. This results in a distinctly different exposure strategy for FEAT compared to the benchmark index. FEAT's investment strategy leads to a concentrated portfolio of 50 stocks or less, and these companies tend to be clustered in specific sectors. Particularly, these sectors are non-cyclical, such as consumer staples and healthcare. Collectively, these two sectors alone compose 67.5% of the portfolio, with over half of the portfolio in consumer staples. Where FEAT differs significantly from the MSCI Emerging Markets Index is in its allocation to technology and financials. However, the different sector allocation is not the only story. If we compare the 5-year performance of FEAT relative to the MSCI ACWI Emerging Markets Consumer Growth Index, an index of companies which derive their revenue from consumer growth trends in emerging markets, we note underperformance of 48.3% by FEAT. This in part seems to stem from FEAT's allocation to consumer staples over more cyclical consumer discretionary stock picks. However, again, this does not tell the full story. Working up to look at the country exposure of FEAT, we can see it differs greatly from the MSCI EM index, where both the EM index and the Consumer Growth Index are dominated by Chinese companies. FEAT has a much reduced allocation here. Also, FEAT has no positions in Taiwan or South Korea, which compose nearly 28% of MSCI's index. FEAT's largest single country allocation is in India at 44.3% of the portfolio. Keen-eyed viewers may note also that 13.7% of the allocation is in the United States. However, this is slightly misleading. The fund is not buying US stocks, but rather emerging market companies which are listed in the United States. For example, Mercado Libre, the fund's second largest position, is a quasi-South American Amazon cum eBay, but it's listed in the US and trades on the Nasdaq exchange. This does highlight the importance of currency exposure. Due to its different country exposure, FEAT's exposure to various currencies differs from that of the index. Compared to the MSCI EM index, which is dominated by large Chinese companies, many of which trade in the US in US dollars, FEAT has effectively been underweight the dollar since inception. Until the middle of 2020, the US dollar had been a really strong performer in global currency markets. So if we take this together, what does this all mean? Well, FEAT has very low overlap with the parent index at around 2%, and 3-year correlation, both with other global equity indices and with MSCI's emerging market index, is fairly low. This scatter plot looks at the risk and return characteristics of FEAT and various ETFs tracking different equity indices. Annualized volatility is on the x-axis and 3-year performance is on the y-axis. Point A is EIMI, that iShares Emerging Markets ETF that we mentioned earlier in the video. B is FEAT. C is VUSA, an S&P 500 tracker. D is SWDA, a popular all-world tracker, again from iShares. And E is the iShares India ETF. What we can see is that FEAT does incur less volatility than EIMI or IIND, that Indian equity ETF. So the benefits of that allocation to consumer staples and non-cyclicals is borne out in the performance of the fund. The new managers have outlined some strategic changes which they hope will turn the fund's performance around. Foremost, they intend to reduce macroeconomic and political risk in the portfolio by reducing their holdings in companies in frontier markets. From 2019 into 2020, they cut all their positions in Pakistan and Ghana and reduced their Nigerian holdings by 2/3. Examining the companies that they hope to buy, they intend to increase their sector diversity, which will mean reducing that allocation in defensive sectors. They will also seek to focus on domestic companies rather than regional subsidiaries of global multinationals. This, they hope, will enable them to buy leaner operations that can move and operate with greater agility. This increased focus will lead to a greater portfolio concentration, and Michael O'Brien stated in a 2020 shareholders meeting that this would be in the region of 35 to 40 stocks. Michael O'Brien stated that he believes this new approach will be better placed to capture the post-pandemic recovery, which may be led by emerging markets, who have benefited from being first in and first out, and any socioeconomic changes and demographic shifts that have been wrought by this. A look at the 1-year performance suggests this may be the case, with FEAT only slightly underperforming a broad emerging markets ETF. However, truly, we would need a longer period to see whether Michael O'Brien's conviction is borne out. So, is FEET a buy? Well, it depends on your conviction in the consumer growth story and in emerging markets, and then your belief as to whether or not Fundsmith's approach is right to capture this. Many investors will likely see this as a satellite holding, but not a core emerging markets position. Given that it is a unique trust with a unique strategy, this may be the right approach to take with your personal capital allocation. Similarly, it may be wise to wait and see how the new management team stacks up before allocating your own capital. However, this is not advice, and any decision that you make is truly your own. Investors should nevertheless be aware of the costs, which have been coming down, but are currently at an ongoing charge of 1.4%. This is high, even for an active emerging markets product, and for those investors who have held through 7 years of underperformance, it's a bitter pill to swallow. Those looking to buy should also be aware of the investment trust structure. Investment trusts have a fixed amount of capital, and they issue shares which trade on an exchange. The price of these shares will move relative to supply and demand, and these can deviate from the net asset value of the trust itself. Buying in when the shares are trading at more than NAV is buying in at a premium. There may also be opportunities to buy below NAV, and this is called buying at a discount. But it cuts both ways, and in times of extreme market volatility, where you may be looking to offload some of your positions, you may well sell an investment trust at a discount, effectively shortchanging yourself. Thank you for watching. We hope you found the information contained useful. If you enjoyed it, please consider contributing using the donate function when you next download one of our reports. However, it is donation only and they can be downloaded for free, so please don't feel obliged. Thank you and good luck investing.